currency prices determined?
Unlike equities, which are traded on a centralized exchange, so you've got the London Stock Exchange for English equities, and you've got the New York Stock Exchange, and maybe some other exchanges, secondary exchanges, there is no centralized exchange for currencies. So it's literally, I pick up the phone to another broker, so you still have voice dealers to this day, sitting at Deutsche Bank, Barclays, etc. You pick up the phone and you say, I want to buy $1 billion worth of euro against dollars, and they'll make you a price. Now, if it's a bilateral transaction, which all these FX transactions are, how do you know that that guy's not cooking the books or he's giving you a favorable price? Well, so we live in the 21st century where you have electronic markets. So you at every other time are plugged into every other price maker. So if that guy's giving you a price that's lower than over here, you can immediately enter a transaction in ARB and make a risk-free profit. So ultimately, the fact that you have people engaged in this kind of high-frequency, low-latency arbitrage between various venues ensures two things: that you have sufficient liquidity to transact, but more importantly, that all the different participants, all the different brokers are kept kosher. So, are kept in check, and they're not going to make you prices that are exorbitantly out of whack. So it's interesting because other than this arbitrage mechanism, there's no real mechanism that'll ensure that you're getting a fair deal from the broker on the other side, because it is this kind of bilateral exchange.
So you've been quoted as saying forex is the flow of cash between countries. Is that still true?
Yes, and going back to what we said about globalization in terms of flow, I mean, a classic example is, China up to now has been the choice or the port of choice for production, certainly Southeast Asia, bigger picture now. And these people, when you go on the street there, you're not going to see people using dollars. They use Chinese yuan, renminbi. So you have to exchange that. So yes, currency transactions are growing as globalization is growing.
Can I trade in a currency I don't already have?
Yes, you can. And we said, going back to what does trading ultimately mean, by looking at the number on the screen and then it just goes up and down. So the classic example, you're here in England and you have pounds, but you'd like to trade, let's say, the dollar versus the South African rand, which is also known as the ZAR, so dollar ZAR. So, and you would like to do that because you have a particular outlook that South Africa is disintegrating to a certain extent, and maybe they can't produce as much gold, they have infrastructure issues, so therefore the ZAR should go down and dollar ZAR should go to the ceiling. So you have neither of those currencies at your disposal, but you can still on your brokerage account buy one, sell the other, or sell the other, buy the other. Now, how does that actually work behind the scenes, especially when you value your P&L? What will happen is that the broker takes your pounds, converts it to dollars to give you the dollars because you bought dollars, and in exchange you sell him the ZAR, which you have to borrow from somewhere. And so what then happens is dollar ZAR moves around, you close the position out, and because it's quit as dollar ZAR, your P&L actually ends up being in South African rand, but you are a sterling holder, so then the broker will convert those ZAR back into pounds. Now this usually is what happens on the international interbank market. What happens with retail brokers, they tend to wrap it more as CFDs, and from their perspective, it's really, I think, just a calculation on the computer, going through the numbers, and then just taking pounds out of your account and putting pounds back in without any physical transaction necessarily happening.